Hi everyone. Today I want to talk about some of the common thumb rules that are used in personal finance. Now, these thumb rules are based on common sense and based on empirical evidence. They give general guidance about common things that need to be done for addressing various issues in personal finance and money management. But definitely one should tweak them based on one's own profile, one's own requirements. So use them with a pinch of salt and adding your own analysis over there. But they can definitely provide a starting point for managing your own money. So let's get started. Thumb rule number one: how much life insurance should one have? That's a very common question people encounter, and they usually get guided by the insurance agents. But I'll provide you answer to this question over here itself so that you can make your own intelligent decision related to buying insurance policy. And the answer to that is having a cover of at least 8 to 10 times of your yearly income. So whatever your yearly income it is, if it is 20 lakhs, you should, according to me, by my recommendation, have at least 2 crores of life insurance cover. Now, the logic behind this is that in case of the unfortunate incident of death happening, the family will suffer the emotional loss, which is irreparable. But to cover the financial loss that comes along with it, um, like since if you are no more, like the whatever earnings you are having, at least for next 10 years, the family should be able to continue with that replacement earnings coming from the insurance cover. And within those 10 years, they will be able to find alternate means of sustenance. So it's just to cover that financial loss that comes from any person who is contributing financially in the family. Okay, let's move to thumb rule number two, and it is related to how much loan one should have. So the answer to this is it shouldn't, the total amount of loan that one has, it includes home loan, personal loan, or any other kind of loan, gold loan maybe, it shouldn't exceed more than 40% of gross monthly income. It is in terms of EMIs, I'm going to say. The total number of amount of EMIs that you are going to pay, it shouldn't total more than 40% of gross monthly income. So that should serve as like how much amount of loan that you can take. Although I will suggest like take lesser loan, but definitely don't exceed this limit of having more than 40% of gross monthly income. These days, pay now and buy now and pay later, those kind of schemes are in vogue, and like at times younger generation get attracted by it to buy gadgets and other glamorous stuff, but that can lead to debt trap, which is definitely not a good thing to have. So avoid debt trap by following this thumb rule. And I'll create one more video later to answer the question, good trap versus bad trap. Sorry, good debt versus bad debt. So good debt is the one which one should have, but bad debt is the one which one should avoid. So I'll create a video to answer that question later. Let's move on to the thumb rule number three. The thumb rule number three is how much one should invest in equity. Now, one creates an investment portfolio in which one should have equity stocks, and one should have some debt instruments, one should have precious metals, one should have some real estate, and some safe investments as well. So this thumb rule basically answers the question how much one should invest in equity, because equity being volatile, investments, they carry risk of volatility. Your money can go up, it can go down also, and as one's age and responsibilities increase, the risk appetite goes down. So the answer to this question is 100 minus your age. So if you are at age of 30, you should be investing 70%. 100 minus 30 is equal to 70. So 70% of your investment portfolio should be in equities. You have good risk appetite. You should be able to digest more volatility. And if you are at the age of 40, the answer will be 60%. And as the age increases, if you're 50, not more than 50% of your total investment portfolio should go in equity. At times, people tend to fall in greed, thinking that equities are going to give good returns, and they invest very heavily in equities. But we have seen in COVID times that stock markets can tank, and it can lead to very heavy losses. And at age of 50 or 60, if one's corpus goes down substantially, it can cause a lot of panic. So to avoid that panic, follow this thumb rule. Again, it's a very general guidance, empirical guidance, based on your own risk appetite. Make your own decision. Thumb rule number 4: how much does one need to save for retirement? Again, that's a very difficult question to answer, but the thumb rule related to it is that at the time of retirement, whatever your income is, that is your pre-retirement income, take 80% of that and multiply it with 20. That's the corpus that you need as a retirement corpus. So I'll explain the logic behind this. At the age of retirement, whatever your income is, it's assumed that you should be able to live with 80% of that pre-retirement income every year. Like if you keep on getting that kind of pre-retirement income, and the assumption is that if you retire at the age of 60, you will have another post-retirement life of 20 years. Again, it's a thumb rule, it's an assumption. It could be more, it could be less, but let's have it as an average 20 years. So based on that assumption, this thumb rule provides 20 times income to replace 80% of pre-retirement income. That's the corpus you need to have at the time of retirement. Thumb rule number 5: how much of emergency fund should one have? The answer to this question is 3 to 6 times your monthly expenses. I'll explain the logic behind this thumb rule. It is that in case of now this emergency typically assumes that your earnings are not going to be there during those periods. So again, the assumption is that within 6 months you'll be able to create alternate source of income. So you should be having that kind of emergency fund, which you should help you sail through that emergency period where you are not able to make any earnings, and you are going to set up your alternate source of income. So 3 to 6 months of expenses is good, but I will suggest to go for even 12 months of expenses or even more, that kind of emergency fund. And this emergency fund should be there out there in some safe, zero volatility kind of instrument, and very liquid instrument, something like a liquid fund. I'll create a video later to explain what is a liquid fund. Thumb rule number 6: in how many years will my money double? It's a very popular thumb rule used all over the world, and the answer to this is 72 divided by the rate of return which will be coming from your investment. If your investment is going to generate 12% rate of return, then 72 divided by 12, within 6 years your money will become double. Interesting, isn't it? And like sequential to this is in how much time the money will become triple, and the thumb rule for that is 114 divided by the rate of interest or the rate of return. Say again, if the rate of return is 12% every year, 114 divided by 12, it will be how much? 8.5 years within which the money will become triple. So within 6 years it becomes double, and within 8.5 years it will become triple. So you see the magic of compounding coming over here. Now the assumption with this thumb rule is that the compounding happens annually. In case the compounding is happening, say, semi-annually, then the thumb rule for doubling of the income will become 70 divided by rate of return, and for tripling it will be 110 divided by rate of return. So depending on how the compounding is happening, take a call. But again, it's a thumb rule. It's an empirical rule. not an exact science. It's based on common sense and to do some quick calculations for related to your money management questions. So that's all thumb rules I wanted to cover in this video. I hope you find this useful and it covers your money management and personal finance related queries. Let me know whether you find it useful. And if you know some thumb rules which I haven't been able to cover in this video, please share them in the comments below. I would like to know about them as well. I know a few thumb rules, but I would like to hear from your side as well. Let's discuss. Join my Mega Money community. We have all these money management related discussions over there, and I really enjoy it, and I hope to serve my audience that way. So join my Mega Money community. Follow me on all social media channels. I'll keep posting more such videos to provide value related to money management. That's all for now. Thank you. Bye.